Item 2. Management's discussion and analysis of financial condition and results of operations. The company is a mobile healthcare services company that uses proprietary dispatch and communication technology to help provide quality mobile, in-person medical treatment directly to patients in the comfort of their homes, workplaces, and other non-traditional locations, as well as medical transportation in major metropolitan cities in the United States and the United Kingdom. The company derives revenue primarily from two operating segments: mobile health services. The services offered by this segment include a wide variety of healthcare services performed at homes, offices, and other locations, and event services such as on-site healthcare support at sporting events and concerts. This segment also provides solutions to large, typically underserved population groups, typically through arrangements with municipalities, which include both physical and mental healthcare services. The services offered by this segment include virtual care and diagnostics, remote patient monitoring, phlebotomy, addressing gaps in care and primary care physician services. Transportation services. The services offered by this segment encompass both emergency response and non-emergency transport services. Non-emergency transport services include ambulance transports and wheelchair transports. Net revenue from transportation services is derived from the transportation of patients based on billings to third-party payors and healthcare facilities. For the 3 months ended June 30th, 2026, the company recorded a net loss of $18.0 million, compared to a net loss of $13.3 million for the 3 months ended June 30th, 2025. For the 6 months ended June 30th, 2026, the company recorded a net loss of $34.7 million, compared to a net loss of $24.3 million in the 6 months ended June 30th, 2025. The mobile health services market is dependent on several factors, including increased patient acceptance of services that are provided outside of traditional healthcare facilities, such as in homes, businesses, or other designated locations, healthcare coverage of the various mobile health services, and, to a lesser extent, continued desire on the part of government and municipal entities to fund programs to assist currently underserved patient segments via population health programs. The transportation services market is highly dependent on patients requiring transportation after surgeries and other medical procedures and treatments. The company primarily focuses on the non-emergency medical transport market, which includes services that are provided to patients who need assistance getting to and from medical appointments. Key drivers of this market are the increase in chronic conditions and the number of elective surgeries, as well as the ongoing aging of the population, as the older demographics tend to be much more frequent consumers of medical transportation services. The inflation rate in the United States, as measured by the Consumer Price Index, has generally trended down since the middle of 2023. The inflation rate declined to 2.7% for the full year 2025, down from 2.9% in 2024, 3.4% in 2023, and 6.5% in 2022. In June 2026, the annual inflation rate decreased to 3.8% from 4.2% in May, which was the highest reading since April 2023. The increase in recent months has been driven by fuel prices. As inflation has moderated, and in an attempt to stimulate economic growth, the U.S. Federal Reserve implemented 3 interest rate cuts in September, October, and December of 2025, lowering its benchmark rate, the federal funds rate, to the current level of 3.50 to 3.75% as of the date of this quarterly report on Form 10-Q. Looking out through the rest of 2026, Docgo anticipates that fuel prices will moderate, particularly as the third quarter comes to a close, and that the inflation rate will remain at or near the currently more moderate level, with an annual rate similar to those witnessed in 2024 to 2025 and the 2010 to 2020 period, when the annual inflation rate ranged from 0.1% to 3.2%. A trip is defined as an instance where the company completes the transportation of a patient to a specific destination, for which we are able to charge a fee. This metric does not include instances where a trip is ordered and subsequently either canceled by the customer or declined by the company. The average trip price is calculated by dividing the aggregate revenue from the total number of trips by the total number of trips, and is an important indicator of the effective rate at which the company is being compensated for its provision of transportation services. Revenues generated from programs under which the company is paid a fixed hourly or daily rate for the use of a fully staffed and equipped ambulance do not factor in the trip counts or average trip prices mentioned above. We expect these fixed-rate, leased-hour programs to continue to account for an increasing proportion of the transportation services segment's revenues in the future. The company did not complete any acquisitions during the 6 months ended June 30th, 2026. During the 6 months ended June 30th, 2025, the company completed one acquisition for $4.2 million. In recent years, the company's government contract work has represented a substantial portion of its overall revenue. While the company expects government contract work to decline, both in absolute dollar terms and as a percentage of overall consolidated revenue, due primarily to the ending of large migrant-related projects in New York, the company continues to bid on government contracts and expects some revenue from this sector in the future. For example, starting in the second quarter of 2023, the company began providing services to the recent migrant population in New York City and in upstate New York. Some of these services were provided pursuant to a contract with an ending date during the second quarter of 2024. While a portion of that contract was extended through December 31st, 2024, other services began to wind down in May 2024. The wind down of all services under such contract was completed in the fourth quarter of 2024. While the company continued to provide services under other contracts during 2025, the wind down of the remaining migrant-related services under other contracts was completed in December 2025, and the company expects that the revenues from any remaining migrant-related projects will be relatively insignificant in 2026. As such, despite the company's expectation for revenue growth in other business lines within the mobile health services segment, we expect that overall mobile health services revenues will be lower in 2026 than they were in 2025, given the absence of migrant-related project revenues. For the 3 months ended June 30th, 2026, total revenues were $73.4 million, a decrease of $7.0 million, or 8.7%, compared to the 3 months ended June 30th, 2025. For the 3 months ended June 30th, 2026, mobile health services revenues were $21.4 million, a decrease of $9.4 million, or 30.5%, compared to the 3 months ended June 30th, 2025. The decline in revenues was due to the ongoing wind-down of migrant-related services. Offsetting the decline in revenues from migrant-related services was the inclusion in the current year period of virtual care revenues from SteadyMD, which was acquired in October 2025. For the 3 months ended June 30th, 2026, transportation services revenues were $52.0 million, an increase of $2.4 million, or 4.8%, compared to the 3 months ended June 30th, 2025. This increase was due to a 10.8% increase in U.S. trip volumes to 80,447 trips in the 3 months ended June 30th, 2026, from 72,598 trips for the 3 months ended June 30th, 2025. The average trip price increased to $426 in the 3 months ended June 30th, 2026, from $410 in the 3 months ended June 30th, 2025. The biggest volume gains were witnessed in New York, Texas, and Tennessee. These increases in volumes and average trip price in the U.S. were partially offset by declines in the U.K. market. For the 3 months ended June 30th, 2026, total cost of revenues, exclusive of depreciation and amortization, decreased by 7.3% compared to the 3 months ended June 30th, 2025, while revenues decreased by approximately 8.7%. Cost of revenues as a percentage of revenues increased to 69.5% in the 3 months ended June 30th, 2026, from 68.4% in the 3 months ended June 30th, 2025. For the mobile health services segment, cost of revenues, exclusive of depreciation and amortization, in the 3 months ended June 30th, 2026, amounted to $15.6 million, down 25.0% from $20.8 million in the 3 months ended June 30th, 2025. Cost of revenues as a percentage of revenues increased to 72.9% from 67.5% in the prior year period, due to the decline in mobile health services revenues from migrant-related projects and the inclusion of lower-margin virtual care revenues from the SteadyMD business line in the current year period only. For the transportation services segment, cost of revenues, exclusive of depreciation and amortization, in the 3 months ended June 30th, 2026, amounted to $35.4 million, up 3.5% from $34.2 million in the 3 months ended June 30th, 2025. Cost of revenues as a percentage of revenues decreased to 68.1% from 69.0% in the prior year quarter, due to the revenue increase, which outweighed the effect of increased compensation and higher vehicle costs. Total compensation increased by 2.6% year-over-year, reflecting increased field headcount and temporary increases in the effective hourly wage for certain shifts in some of the company's markets, as the company aggressively expands its staff in order to reduce its reliance on subcontractors. Cost for subcontractors declined by 17.9% when compared to last year's second quarter, reflecting a planned reduction in the number of ambulance trips that were completed by subcontractors in instances where the company previously did not have sufficient personnel capacity to provide the requested services. Vehicle costs were driven higher primarily due to increased fuel costs, reflecting higher prices for gasoline throughout the quarter, which have continued into the third quarter. For the 3 months ended June 30th, 2026, the company recorded $40.3 million of operating expenses compared to $42.9 million for the 3 months ended June 30th, 2025, a decrease of 6.1%. The decrease of $2.6 million in operating expenses related primarily to a decline of $0.5 million in total compensation, a $0.6 million decline in subcontractor costs, and a $1.3 million decline in depreciation and amortization, reflecting the write-down of intangible assets in the third and fourth quarters of 2025. For the Mobile Health Services segment, operating expenses in the 3 months ended June 30th, 2026 were $11.0 million, up 3.8% from $10.6 million in the 3 months ended June 30th, 2025, as the investments made in the company's nascent care gap closure business and the inclusion of operating expenses from the Steady MD business, which was acquired in October 2025, outweighed the elimination of operating expenses related to the weaned-down migrant-related projects. For the Transportation Services segment, operating expenses in the 3 months ended June 30th, 2026 were $16.3 million, up 1.2% from $16.1 million in the 3 months ended June 30th, 2025. For the Corporate segment, operating expenses in the 3 months ended June 30th, 2026 were $13.0 million, down 19.8% from $16.2 million in the 3 months ended June 30th, 2025, due to reduced corporate headcount, lower subcontractor costs, and a 34% decline in professional fees, all relating to the company's ongoing cost-cutting efforts. For the 6 months ended June 30th, 2026, total revenues were $149.0 million, a decrease of $27.5 million, or 15.6%, compared to the 6 months ended June 30th, 2025. For the 6 months ended June 30th, 2026, Mobile Health Services revenues were $45.0 million, a decrease of $30.9 million, or 40.7%, compared to the 6 months ended June 30th, 2025. The decline in revenues was due to the ongoing wind-down of migrant-related services. Offsetting the decline in revenues from migrant-related services was the inclusion in the current year period of virtual care revenues from Steady MD, which was acquired in October 2025. For the 6 months ended June 30th, 2026, Transportation Services revenues were $104.0 million, an increase of $3.5 million, or 3.5%, compared to the 6 months ended June 30th, 2025. This increase was due to a 9.2% increase in U.S. trip volumes to 160,159 trips in the 6 months ended June 30th, 2026, from 146,728 trips for the 6 months ended June 30th, 2025. The average trip price increased to $417 in the 6 months ended June 30th, 2026, from $394 in the 6 months ended June 30th, 2025. The biggest volume gains were witnessed in New York, Texas, and Tennessee. These increases in volumes and average trip price in the U.S. were partially offset by declines in the U.K. market. For the 6 months ended June 30th, 2026, total cost of revenues exclusive of depreciation and amortization decreased by 14.6% compared to the 6 months ended June 30th, 2025, while revenues decreased by approximately 15.6%. Cost of revenues as a percentage of revenues increased to 68.9% in the 6 months ended June 30th, 2026, from 68.1% in the 6 months ended June 30th, 2025. For the mobile health services segment, cost of revenues exclusive of depreciation and amortization in the 6 months ended June 30th, 2026, amounted to $32.0 million, down 38.6% from $52.1 million in the 6 months ended June 30th, 2025. Cost of revenues as a percentage of revenues increased to 71.1% from 68.6% in the prior year period, as the decline in mobile health services revenues from migrant-related projects outweighed the growth in higher-margin service lines, such as mobile phlebotomy and remote patient monitoring. For the transportation services segment, cost of revenues, exclusive of depreciation and amortization, in the 6 months ended June 30th, 2026, amounted to $70.7 million, up 3.8% from $68.1 million in the 6 months ended June 30th, 2025. Cost of revenues as a percentage of revenues increased to 68.0% from 67.8% in the prior year quarter, despite the revenue increase, due to increased compensation and higher vehicle costs. Total compensation increased by 5.3% year-over-year, reflecting increased field headcount and temporary increases in the effective hourly wage for certain shifts in some of the company's markets, as the company aggressively expands its staff in order to reduce its reliance on subcontractors. Costs for subcontractors declined by 21.1% when compared to last year's first half, reflecting a planned reduction in the number of ambulance trips that were completed by subcontractors in instances where the company previously did not have sufficient personnel capacity to provide the requested services. Vehicle costs were driven higher primarily due to increased fuel costs, reflecting higher prices for gasoline starting in March, which continued throughout the second quarter. For the 6 months ended June 30th, 2026, the company recorded $82.9 million of operating expenses compared to $87.8 million for the 6 months ended June 30th, 2025, a decrease of 5.6%. The decrease of $4.9 million in operating expenses related primarily to a decline of $2.0 million in total compensation, a reduction of $1.5 million in subcontractor costs, and a $2.4 million decline in depreciation and amortization charges, reflecting write-downs of intangible assets in the second half of 2025, partially offset by $1.0 million increases in legal, regulatory, and technology and development expenses. For the mobile health services segment, operating expenses in both the 6 months ended June 30th, 2026 and 2025 were $22.1 million, as the elimination of operating expenses related to the wound-down migrant-related projects were offset by investments made in the company's nascent care gap closure business and the inclusion of operating expenses from the Steady MD business, which was acquired in October 2025. For the transportation services segment, operating expenses in the 6 months ended June 30th, 2026 were $33.0 million, up 3.8% from $31.8 million in the 6 months ended June 30th, 2025. For the corporate segment, operating expenses in the 6 months ended June 30th, 2026 were $27.8 million, down 18.0% from $33.9 million in the 6 months ended June 30th, 2025, due to reduced corporate headcount, lower subcontractor costs, and decreased professional fees relating to the company's ongoing cost-cutting efforts. During the 6 months ended June 30th, 2026, the company recorded a $2.8 million loss on the change in fair value of contingent consideration, reflecting an improved revenue outlook for the Steady MD business, which was acquired in October 2025. During the 6 months ended June 30th, 2026, the company recorded $4.7 million in other income from insurance proceeds. The company was reimbursed in the 2026 period for legal fees that were covered by the company's insurance policy. On August 7th, 2025, the company amended and restated the prior credit agreement. The credit agreement provides for the revolving facility of up to an aggregate principal amount of $55.0 million, and borrowings thereunder are subject to a borrowing base formula based on eligible receivables as described therein. The revolving facility includes the ability for the company to request an increase to the commitment by an additional amount of up to $20.0 million, though neither lender nor any other lender is obligated to provide any such additional commitment. The revolving facility matures on November 1st, 2027, the 5-year anniversary of the original closing date of the prior credit agreement. The credit agreement is secured by a first priority lien on substantially all of the company's present and future personal assets and intangible assets. The credit agreement is subject to a certain minimum liquidity financial covenant based on the prior 12 months cash burn and the company's available cash balances and borrowing ability under the credit agreement. As of December 31st, 2025, the company was no longer in compliance with such covenant under the credit agreement. The company is currently in active discussions with its lender to reach a resolution regarding the covenant non-compliance and to preserve its ability to draw from the revolving facility as needed. There can be no assurance that the company will be successful in reaching a resolution or that the revolving facility will remain available. However, these discussions are still progressing as of June 30th, 2026. Considering the foregoing, including historical operating losses, the projected liquidity deficit, and the covenant non-compliance under the credit agreement, the company, together with its board of directors, has reviewed and extensively discussed certain plans intended to reduce cash utilization and operating costs, including transitioning a larger portion of bonus compensation from cash to company stock, intensified collection efforts focused on closing out open municipal receivables from ended contracts, reducing headcount, and delayed spending on certain business growth strategies, as well as utilizing the revolving facility, subject to obtaining the necessary waiver from its lender. In addition, the company is in active discussions with alternative lenders for either a new revolving line of credit or for a term loan. These discussions were ongoing as of June 30th, 2026. While these plans carry meaningful inherent risk to operations, the company's management and the board of directors have evaluated these conditions in totality and conclude it is probable that, when implemented, the plans will be sufficient to alleviate substantial doubt about the company's ability to continue as a going concern for the next 12 months. During the 6 months ended June 30th, 2026, operating activities used $13.9 million of cash, due to a net loss of $34.7 million. Non-cash charges amounted to $16.8 million and included $5.9 million of stock compensation expense, $5.4 million in depreciation of property and equipment and right-of-use assets, $2.8 million in bad debt expense, a loss on change in fair value of contingent consideration of $2.8 million, and a loss on disposal of fixed asset of $0.1 million. These were partially offset by $0.2 million in accretion of discount related to restricted investments. Changes in assets and liabilities resulted in approximately $4.0 million in positive operating cash flow, as a $3.8 million decline in accounts receivable, a $0.1 million decline in prepaid expenses, and a $2.8 million increase in accounts payable were partially offset by a $2.5 million decrease in accrued liabilities, a $0.1 million increase in operating lease liabilities and right-of-use assets, and a $0.1 million increase in other assets. During the 6 months ended June 30th, 2026, investing activities used $2.2 million of cash and restricted cash and consisted of the purchase of restricted investments of $7.5 million, the capitalization of software development costs of $1.5 million, and the purchase of property and equipment totaling approximately $0.7 million, which were partially offset by $7.5 million in proceeds from the sale and maturity of restricted investments. During the 6 months ended June 30th, 2026, financing activities used $4.1 million of cash, as the company made $3.0 million in payments under the terms of finance leases, made $1.0 million in distributions to non-controlling interests, and made $0.1 million in payments due to seller. The company has entered into MSAs with PCs that employ or contract with physicians and other health professionals in order to provide healthcare services to the public. Each such PC is established and operated pursuant to the requirements of its respective domestic jurisdiction governing the practice of medicine. The company provides each PC with everything the PC needs to operate except for clinicians, for which the PC is responsible. Without the administrative services, software, intellectual property, and administrative personnel, among other things, provided by the company, the PCs could not carry out their businesses. Moreover, the PCs do not have sufficient equity to finance their activities without additional subordinated financial support. Based on the foregoing, these entities are considered VIEs, and an enterprise having a controlling financial interest in a VIE must consolidate the VIE if it is the primary beneficiary, meaning it has 1. The power to direct the activities of the VIE that most significantly impacts the VIE's economic performance, power, and 2. The obligation to absorb losses of the VIE that potentially could be significant to the VIE, or the right to receive benefits from the VIE that potentially could be significant to the VIE. Benefits. In accordance with corporate practice of medicine restrictions, all clinical treatment decisions are made solely by licensed healthcare professionals engaged by the PCs. Nevertheless, the PCs cannot operate without the company through the MSAs. Therefore, the company significantly impacts the economic performance of the PCs and funds and absorbs all losses of its PCs. The company has therefore determined that it is the primary economic beneficiary of the PCs and appropriately consolidates them as VIEs. As of January 1, 2026, the company held a beginning balance in its allowance for credit losses on accounts receivable of $8.3 million. The company recognized an additional provision for credit losses and write-offs of $1.1 million and $1.1 million, respectively, for the 3 months ended June 30, 2026, and $2.8 million and $2.6 million, respectively, for the 6 months ended June 30, 2026. The company's balance in its allowance for credit losses amounted to $8.5 million as of June 30, 2026.